Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Friday, 28th November. Coming up on the show, an outage at the CME disrupts trading across the globe. Online sales are on the rise during this critical holiday season. And Apple looks set to become the world's top phone maker. So grab your coffee and let's own the morning. The first thing you need to know is that an outage at the Chicago Mercantile Exchange has disrupted trading across the globe. The outage was caused by a data center fault. Live trading in futures and options across several markets, including bonds, equities and commodities, have all been affected. And the halt has impacted not just contracts for the likes of the S&P 500, but also trade in US treasuries and US crude oil for several hours. The next thing you need to know is all about the labour market. Analysis by Goldman Sachs suggests that the labour market is weakening further. This research comes as President Trump has called for reverse migration. He announced the crackdown on immigration following the shooting of 2 National Guard members in Washington. Trump said on Truth Social that he would, quote, permanently pause migration from all third world countries. Recent data shows that more than 1.2 million immigrants left the workforce over the first 7 months of 2025. And the third thing you need to know about is all about shopping over this holiday season. Online sales in the US on the Thanksgiving holiday are expected to rise 6% compared with last year to reach $8.6 billion. That's according to data from Salesforce. Thanksgiving and today, Black Friday, usher in the holiday shopping season's most critical stretch that typically delivers about a third of US retailers' yearly sales and profits. Now, Black Friday, which is the biggest day of the year for online shopping, is expected to drive $78 billion in online global sales and $18 billion in the US. Well, in the past on Black Friday, you'd rush into a big box retailer and perhaps elbow a few people out of the way to grab a bargain. But now AI is changing that shopping process. Well, here's our tech editor Dan Howley to explain how.
Black Friday tech shopping is getting a lot more complicated this year with tariffs and supply pressures quietly pushing prices higher on everything from accessories to video game consoles. For more, we're bringing in Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, there's a kind of a complicated Black Friday situation here. Some good ways, some bad ways. We have obviously generative AI. It's finally, kind of taken off. Everybody is using it seemingly, just not my dad who can't figure out his iCloud password, but I digress. It's very helpful in that you can make more personalized requests when you're looking for gifts for someone. So for instance, my nephew is 8. He likes Legos, action figures, and sports. And so I could put all of that into something like ChatGPT, which now has a shopping offering. They just launched that the other day into Microsoft's Bing Copilot. You could use Gemini, and they'll provide you with some really good ideas as to what to buy. I did not know that they make Lego sports sets, but apparently they do, and I found that out while shopping. So that's part of the good side of things. The bad side of things is that Black Friday is also going to have to contend with tariffs. And so, in addition to those gifts, tariffs will probably be under your tree if you have a tree in the morning on Christmas. And so, we're seeing things like electronics get hit particularly hard. You saw there, those video game console prices, they went up earlier this year in August and May. Microsoft's particularly hit hard. They had to raise the prices on their consoles twice. Sony had to raise the price on the PlayStation 5 by $50. Nintendo, that's the original Nintendo Switch, by the way, which came out in 2017. They raised the price on that. So, look, you have a console that's almost 10 years old, and somehow it's worth more money now than it was then. So, outside of depreciation and whatnot. So, we're seeing these tariffs impact different things. And then on top of that, computers are exempt from tariffs. Displays are exempt from tariffs, but they're not exempt from the broader issues that we're seeing in the market, which is the data center build out. Memory is now getting more expensive, and not exactly clear if the pricing is going to hit before the holidays or after, but just keep that in mind when you're shopping. If you can find a very good deal, go for it. And as for those video game console prices, obviously they're usually big sellers for the holidays. I actually saw a PlayStation on sale, $100 off at Best Buy. If I didn't have one already, I'd be buying that for myself.
Well, Apple is set to overtake Samsung and become the world's top phone maker. That's according to Counterpoint Research. It says that the American tech giant will actually ship 243 million iPhones this year to give it a market share of 19.4% compared to Samsung's 18.7%. Now, Samsung sales are rising as well, but not at the same pace as Apple's. This means that for the first time in 14 years, Apple is number one and Samsung is number two. Apple's success has been driven by the successful September launch of the iPhone 17 series, not only succeeding at home, but also in that critical Chinese market. Now, Samsung, meanwhile, could face challenges in the low to mid-tier of the smartphone ecosystem from Chinese players, which could hamper the South Korean giant's ability to reclaim that top spot. The hit to Apple from tariffs has also been less than forecast. That's due to the US-China trade truce. Plus, a weaker dollar has also helped its sales abroad. And the competition between the two biggest smartphone makers looks set to intensify even further. Not only is Apple bringing out an entry-level iPhone 17e next year, it's also releasing a foldable smartphone to rival Samsung Galaxy's Z Fold series. Now, however, the battle to be top dog when it comes to smartphone sales doesn't seem to be reflected in the company's respected share performances this year. Yes, Apple share prices are higher, but Samsung Electronics shares have performed almost 9 times better in 2025 so far. Okay, it's time for a short break. And yes, it is Black Friday, so you're probably in the mood for shopping. How about some stocks? Well, Jared Blickery has some tips on how to spot a bargain when we return. Welcome back. So if you're on your computer looking for Black Friday bargains, you might want to pick up some shares too. But how do you spot good value when it comes to stock picking? Well, here's our markets and data editor, Jared Blickery.
It's that time of year when everybody's hunting doorbusters and bargains, but while you're fighting for half-price air fryers, there is another clearance aisle hiding in plain sight. That's going to be value stocks. And that's what we're digging into on today's Stocks in Translation. Cheap names with real earnings power, showing you how to build your own holiday stock shopping list with the Yahoo Finance data and tools. Let's start with what a value stock is. It's a stock price low versus its earnings, its assets, or its cash flow, leaving room for upside if expectations improve. Think of it as a good jacket on the sale racket. Nothing wrong with the fabric, it's just maybe out of favor or in the wrong size pile. But if the fundamentals hold up, you're basically paying less than full price for the same underlying business. But every sale rack has its studs. And in the stock market, that is called the classic value trap. Now, that is a stock that looks cheap, but keeps falling because their business is deteriorating, and not just because Wall Street sentiment is temporarily negative. Maybe earnings are starting to roll over, maybe the industry is shrinking, or maybe the dividend is about to be cut. On screen, it looks like a steal, but you soon face regret. So be careful, because in stock picking, there are no returns. Now, let's build a shopping list using the Yahoo Finance Screener. You can find a great preset just by searching Yahoo Finance Screener and clicking on Undervalued Growth Stocks. And here we have some of the categories here. Over 100 names are going to pop up in the results. So let's check in on the filters it's using, then we can whittle down that list. So it starts here with a trailing price to equity ratio from 0 to 20. So you're basically paying under $20 for each dollar of last year's profits. It uses the so-called PEG ratio at a setting of below 1, which means that the price is low compared with how fast earnings or profits are growing. It requires earnings per share to be at least 25% above 1 year ago. So we're not buying total laggards. And it limits the baskets to companies listed on the NYSE or the NASDAQ, just the major US exchanges. Now here's the basket that I ended up with, and we're showing year-to-date returns here on this heat map. I took out all the companies under $1 billion in market cap, and I'm looking for companies paying a nice dividend so that you get paid even if the stock price goes nowhere. You can do this by sorting or filtering for forward dividend yield. But always research the dividend situation of a company, because too good to be true usually is. When a stock price gets beaten down, the dividend yield goes up, and it can look huge on the screen. Sometimes it's a real doorbuster, sometimes it's a sign that the market expects a dividend cut. Now, let's take a look at two of the bigger names. Take Pfizer here. It looks like a classic value trap, and I'm going to put this on a 5-year so you can see the performance. This is after its stock COVID business fell off a cliff and the stock price dropped. So it's down 3% this year, and the company still pays a hefty dividend around 6 to 7%. But cash flow is tighter as it spends to rebuild the drug pipeline, which is why the PEG looks weak. It's real income today with real questions about longer-term growth. Then let's take a look at Ford here, which is cyclical value, tied to the US economy with a big sticker yield around 5 to 6%. It pays a regular dividend, but profits are under pressure from EV losses and a choppy auto cycle. And also, guidance has come down. Its negative PEG ratio tells you that Wall Street expect earnings to shrink, not to grow. This is a doorbuster where the yield is real, but the fundamentals, they have to earn it. It's up over 30% this year, but it's still been cut in half from its 2022 all-time highs. So, how do you keep your holiday value basket from turning into a bag of returns? Here is what to watch next, and I got a nice little list here for you. First, you want to watch out for earnings results and guidance. Are the profits still growing, or are they starting to roll over? Then look for dividend changes, hikes, pauses, cuts, because the income line is often the first place stress shows up. Next, check in on your basket and how it's doing versus the S&P 500 or the NASDAQ over time. And finally, watch for changes in interest rate expectations and chatter, because shifts in rates can swing the pendulum between value and growth. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
Well, we're heading for another short break, but stick with us. We'll be back with trending tickers, including one infamous meme stock. Plus, we'll be taking a closer look at debt being piled up, all in the name of AI. It's time now for today's trending tickers. First up, a story that keeps weighing on one of Wall Street's biggest names, Jefferies. It's facing new troubles again over its links to the bankrupt auto parts company First Brands. Now, according to the Financial Times, regulators are examining Jefferies' role in arranging financing transactions tied to First Brands before the company collapsed. The report says that the SEC is reviewing whether Jefferies adequately disclosed risk and its own exposure linked to those deals. No official comment yet from Jefferies or from regulators, but the headline alone makes this stock a big one to watch on today's shortened trading session. Now from Wall Street to Wall Street Bets. The stock that made the Reddit channel famous is rising again. We're of course talking about GameStop. It's up sharply in early trade there, over 3.5%, extending yesterday's momentum. The move is driven by, you guessed it, a new wave of retail buying tied to renewed social media chatter overnight, with trading volumes bringing GameStop back on the list of the most active stocks on Yahoo Finance this morning. No significant news from the company, but many retail investors are placing bets ahead of GameStop's earnings next week. Moving on to Delivery Hero over in Europe. Now, Delivery Hero is on the move in Frankfurt after Bloomberg reported that some of the company's larger shareholders are pushing for a sale. The pressure comes after the stock underperformed this year, but, well, it definitely seemed to be recovering some value in early trading, with the stock jumping about just under 14% there. For a few days now, we've seen Delivery Hero appear on some list of stocks that seem trading at a discount. We'll see if that holds and what strategic decisions the company makes. Next up, it's a tough retail day for two big names in apparel and fashion. Puma and Burberry are both trading lower after new Euro area retail data this morning showed continued weakness in discretionary spending. For Burberry, analysts also point to ongoing concerns about China demand. And last but not least, Alibaba. The stock is struggling for direction after the company unveiled new smart glasses hardware powered by its much talked about Qwen AI model. It's the latest in a string of AI announcements this month from the Chinese giant. The device shown at a developer event in China integrates real-time translation, multimodal recognition, and on-device Qwen processing. Alibaba has been pushing aggressively into consumer AI, and each new reveal has fueled debate about how close the Chinese tech giants are to competing head-on with Western AI players. All right, let's move on to a different subject now. Tomorrow is Small Business Saturday across America, with events organised on high streets across the country. My colleague Julie Hyman got some tips from her guest Elizabeth Gore on how to support your local businesses at such a difficult time.
So if I'm a shopper, what is the best ways to find these small businesses if I want to patronize them?
Oh, I'm so excited about, as y'all were saying earlier, AI. Just jump into your chat GPT. And if you want to do it from a geographic standpoint, if you're in LA and you're looking for pretzels, you'll probably find Shappy's Pretzels. If you are in New York and you're saying, what are the best baked goods? Put that in there. In New York City's and Baked by Melissa is going to pop up. So it actually should be easier than ever. Also, most small businesses are also shipping, which is an exciting time. It's getting easier, particularly with their own stores and things like Shopify, for them to ship out. So you should be able, and even now you can say, hey, I want small business and I want veteran owned. So you can do a double search for your community and give back to those who are employing your friends, your neighbors, your cousins, and everyone you love.
And how are these small businesses navigating the tariff and inventory situation right now, right? And making sure they've got enough inventory in their stores heading into this holiday weekend?
You know, since COVID, this is the toughest time for supply chain. Part of that is still coming out of the tariffs issue. As I said earlier, folks are waiting on that SCOTUS argument to see if tariffs are going to stand. It depends on where they've diversified, where they're getting their items. If they're in one country and those tariffs are high, they've had to wait. Now, some small businesses have stocked up and tried to keep things local, so they're not having to pay those high prices, but ultimately, it will be passed on to the consumer. And I just ask for consumer patience because your bakery does need to pass along that cost to stay alive.
How much debt is too much debt? OpenAI's data center partners have now amassed around $100 billion in debt. Listen to this. That's as much as the 6th largest private borrowers in the world combined. So OpenAI's data center partners have more debt than Volkswagen, Toyota, Comcast, AT&T and others combined. That's according to new reporting from the Financial Times that you can read on Yahoo Finance. But here's the even more striking twist. This isn't OpenAI taking on the debt. It's everyone around it. SoftBank, Oracle, CoreWeave, Crusoe Energy, Blue Owl and more. All borrowing massively to build the data center muscle OpenAI needs for its next leap in AI. It's being financed through loans, special purpose vehicles, infrastructure credit, and private equity structures. It's the biggest AI debt pile we've ever seen. Take Oracle as an example. Morgan Stanley points out that if you want to buy credit protection on its giant debt, the cost of that insurance is nearing record highs. So a lot of people out there basically think it's time to short Oracle. So how is this borrowing spree justified? Remember, training and running models like video generators and building so-called artificial general intelligence requires astronomical compute. But here's the flashing warning sign, and it's coming from the bank HSBC. The bank calculates that OpenAI is headed for an annual bill of hundreds of billions of dollars a year, and its current revenue this year, according to Sam Altman himself, will only be around $20 billion. So today's call is simple. Even with OpenAI's soaring valuation, currently at around $500 billion, and even with very fast revenue growth, the question of how the company's ecosystem is going to pay its bills and sustain these humongous levels of debt isn't going to go away anytime soon. Okay, before we go, let's talk about trading in 2026. Sahil Matani from 91 Investments shared his predictions with Josh Lipton.
NVIDIA has given us good guidance for the next 3 to 4 quarters. So actually, in some sense, we have confidence that this isn't, the AI bubble, quote unquote, is not going to burst soon. But clearly, there's a reassessment about whether unit costs in AI can continue to be so negative. We've had a period where unit costs in Uber or Amazon were negative, but then, the $3 cab ride that you got to cross the city, that disappeared. And so we're probably past this point where unit costs can keep being negative. I think investors are going to start asking questions about, the productivity gains that will ultimately justify the hundreds of billions in the AI data center spending. And when I see numbers like we have to cut 5% of all global labor costs to make this work, I do think that is slightly pie in the sky. So I'm not pessimistic on AI. I think it's going to have to show more progress to earn confidence. I think the way we're framing it is the risks of a super bubble, which we thought was relatively likely, sort of akin to what you had at the tail end of the 90s, that the risks of that have actually gone down in the last few weeks because investor skepticism has increased. But we still think AI is going to do very well, and we still think ultimately it's a transformative technology that will have a huge amount of cut through, particularly through those professional services industries I mentioned earlier.
Finally, Sale, it's interesting, AI's impact on the market, and I want to get your take on the Fed's impact on the market as well. In the sense, Sale, that I mean, listen, we started questioning whether there was going to be a cut next month. Right, it became a coin toss or something less, and jitters started popping up. Now we've become convinced, okay, the cut's more likely next month, and green across my screen. I'm just curious how you think about that dynamic.
Yeah, so look, big picture, you as an investor have to think about whether growth or inflation is going to dominate in the coming year. If inflation is going to dominate, then your bond equity correlation goes positive and it becomes harder to own bonds. And if growth is going to dominate, then actually things are relatively assured and you can own bonds and equities, and actually that should be a benign environment. We think inflation is set to come down. We think as a result, Fed policy is set to be in a relatively easy mode, more worried about unemployment than inflation. And as a result, we think the Fed is going to cut in December, cut a few more times next year. And we think 2026 is a good year. It's a year where bears get slaughtered again. And that's how we think about it. So you have to start from the kind of underlying growth and inflation dynamics and then think about policy.
Okay, before we go, let's check in on the markets. Let's start with gold. Now, note this is a futures price from last night due to the outage. Trading has been pretty choppy in the spot market as a result too. We're just hearing news that some of the Forex markets at the CME are starting to open now. Let's move on to the Asian markets now, and markets pretty mixed to be fair. Japan's Nikkei had its third straight day of gains after inflation eased back to 2.7% in October. Let's turn to Europe now, and European stocks were mixed this morning as investors digest the end of a choppy month, actually slightly higher right now. Okay, shares of drug giant Novo Nordisk are up, actually. Perhaps investors buying the dip here after it agreed to cut prices to Medicare users of its obesity drugs. All right, let's check in on the US markets now as well. When trading resumes later this morning, the Wall Street indices will be staring at a losing month, even though markets are in the green there from last night as well. A sharp cool down in the megatech cap names has led a decline for November as investors reassess how quickly AI-driven businesses can translate hype into sustainable profits. Okay, that's it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. I'm Ramzan Karmali. Go own the morning.